Hello guys and welcome to the channel. This is lesson 2, which is a continuation of Forex beginner classes. If you haven't watched the previous lessons, I would recommend that you watch it in order not catch up. I will leave a link in the description box below. Feel free to leave a comment and thank you to those who left their comments. Let's jump into the video right away and waste no time. In this lesson, we will look into knowing when to buy and sell currency pairs based on fundamental analysis. While giving examples, we will also look at trading lot, margin trading, and lastly, I will look at interest rates in brief. In Forex trading, the decision to buy or sell a currency pair is influenced by factors analyzed through fundamental analysis. This analysis focuses on the overall economic state of a country, including productivity, employment, manufacturing, international trade, and interest rates. Forex trading involves trying to predict which currency will rise or fall versus another currency. How do you know when to buy or sell a currency pair? In the following examples, we are going to use a little fundamental analysis to help us decide whether to buy or sell a specific currency pair. The supply and demand for a currency changes due to various economic factors, which drive currency exchange rates up and down. Like I said at the beginning of this video, each currency belongs to a country or region. So Forex fundamental analysis focuses on the overall state of the country's economy, such as productivity, employment, manufacturing, international trade, and interest rates. We will cover fundamental analysis in a later lesson. Let's look at some of these examples. 1. Euro to US dollar. In this example, the euro is the base currency and thus the basis for the buy-sell. If you believe that the US economy will continue to weaken, which is bad for the US dollar, you would execute a buy euro to US dollar order. By doing so, you have bought euros with the expectation that it will rise versus the US dollar. If you believe that the US economy is strong and the euro will weaken against the US dollar, you would execute a sell euro to US dollar order. By doing so, you have sold euros with the expectation that it will fall versus the US dollar. In this example, the pound is the base currency and thus the basis for the buy-sell. If you think the British economy will continue to do better than the US in terms of economic growth, you would execute a buy pound sterling to US dollar order. By doing so, you have bought pounds with the expectation that it will rise versus the US dollar. If you believe the British economy is slowing while the American economy remains strong like Chuck Norris, you would execute a sell pound sterling to US dollar order. By doing so, you have sold pounds with the expectation that it will depreciate against the US dollar. In Forex, it would be just as foolish to buy or sell 1 euro, so they usually come in lots of 1,000 units of currency, micro lot, 10,000 units, mini lot, or 100,000 units, standard lot, depending on your broker and the type of account you have. More on lots later. Margin trading. Imagine you don't have enough money to buy 10,000 euros. Can you still trade? You can. By using leverage. When you trade with leverage, you wouldn't need to pay the 10,000 euros up front. Instead, you'd put down a small deposit, known as margin. Leverage is the ratio of the transaction size, position size, to the actual cash, trading capital, used for margin. For example, 50-to-1 leverage, also known as a 2% margin requirement, means $2,000 of margin is required to open a position size worth $100,000. Margin trading lets you open large position sizes using only a fraction of the capital you'd normally need. This is how you're able to open $1,250 or $50,000 positions with as little as $25 or $1,000 deposit capital in your account. You can conduct relatively large transactions with a small amount of initial capital. When you decide to close a position, the deposit, which is the margin that you originally made, is returned to you and a calculation of your profits or losses is done. This profit or loss is then credited to your account. Let's review the pound sterling to US dollar trade example above. Pound sterling to US dollar went up by a mere half a pence. Not even 1 pence. It was half a pence. But you made $500. If your position size was £1, yes, you would have made only half a pence. But, Your position size was £100,000 or $150,000 when you opened the trade. What's neat is that you didn't have to put up that entire amount. All that was required to open the trade was $3,000 in margin. $500 profit from $3,000 in capital is a 16.67% return in 20 minutes. That's the power of leverage trading. A small margin deposit can lead to large losses as well as gains. It also means that a relatively small movement can lead to a proportionately much larger movement in the size of any loss or profit, which can work against you as well as for you. You could have easily lost $500 in 20 minutes as well. High leverage sounds awesome, but it can be deadly. For example, you open a FOREX trading account with a small deposit of $1,000. Your broker offers 100-to-1 leverage, so you open a 100,000 euros per USD position. A move of just 100 pips will bring your account to $0. A 100 pip move is equivalent to €1. You blew your account with a price move of €1. If you made it till this far with watching the video and you find it educative, you can support the channel by giving the video a thumbs up, subscribing to the channel and hitting the bell icon to get notified anytime I upload a video. Feel free to leave a comment in the comment section to know what you need for clarification based on what we have covered.